Leading economists have mixed views on global economic growth prospects. This is according to a World Economic Forum survey. 45% of the respondents anticipate that a global recession is still on the cards, while a further 45% don't expect a recession. Economists generally don't believe that the recent bank failures in the United States will have a major systematic impact on global markets, but they add that the financial system may be subjected to further turbulence this year as central banks continue to wrestle with inflation.
We just, as emerging markets came out of COVID, starting the recovery, hit by price shocks related to food, energy on the back of the war. Now, this risk of financial stability, and just coming out of the spring meetings in Washington, again, a very important message on what central banks should do, this trade-off between financial stability versus inflation and growth. So these are real questions. You said the prospects, and you also said concerns. I think the concerns are way more now, and we have to work through these concerns to create prospects.
And now to discuss this issue a bit more further, we are now joined by Professor Roux. He is an economist at the Stellenbosch University School of Business. Thank you so much, Professor, for joining us this evening here on the late edition. We have seen the World Economic Forum survey. They're really here divided. Some are saying that we are heading towards a recession, while others believe not. What are your thoughts? Do you think that we are edging closer to a recession?
Thank you, and good evening, all your late-night viewers. I think perhaps we just need to go back a little bit in history and remind ourselves that since 2009, the world has experienced two very severe recessions. The first one, 2009, sort of prompted by financial turbulence, and then obviously the more recent one by COVID-19 and lockdowns. And that's a very rare event to have two huge recessions in such a short period of time. If we fast forward to the 2020 recession, the lockdown recession, then obviously we saw hugely negative growth rates across the planet. 2021, we saw a rebound. And then just as we thought maybe we've managed to drag ourselves out of this awful recession and head towards better times, along came inflationary pressures, as some of your earlier speakers, the World Economic Forum, has mentioned. And this came out of almost nowhere. For a good 10 years or longer, inflation rates across the globe had been exceptionally low, and therefore interest rates had been exceptionally low, in some cases lower than ever before. But then during the course of 2021, inflation rates started rising, partly because of pent-up demand, partly because of supply chain constraints. And then, of course, 2022, we saw the Russian invasion of Ukraine, and that really accelerated inflation. Now, the reaction, as we know, in many parts of the world, including South Africa, the reaction by central banks is to try to combat inflation by raising interest rates. And the timing could not have been worse for a world economy trying to, as I said earlier, drag itself out of awful recessions. So we have seen naturally a marked slowdown again in economic growth rates. Now, if we think towards the end of last year, the last quarter of last year, I think there wasn't a consensus, but there's a fair degree of a majority of economists and observers and analysts suggesting that in this year, 23, we might indeed be looking at a recession. But then we saw that the second half of last year wasn't too bad in terms of growth. So the thoughts started changing away from a full-blown recession to just a low growth scenario, not negative growth, but low growth. And that is pretty much probably where we're heading right now. Low growth, not negative growth, low growth, but still accompanied by fairly high inflation rates. Thankfully, inflation rates have probably peaked internationally, which means we're probably reaching the end of the upward cycle in interest rates, but inflation rates still remain historically high in many parts of the world. So we might be looking at a situation often called stagflation, a combination of low economic growth, not negative, accompanied by still fairly high inflation rates. And stagflation is not a very comfortable situation. It makes life for policymakers extremely difficult. Central banks, as we all know, as it been pointed out repeatedly, generally have a mandate to control and combat inflation. So if inflation is still high, interest rates will remain high or high-ish, and that will subdue economic growth. Alternatively, if some do decide to address growth by lowering interest rates aggressively, the price you pay is much higher inflation rates. So it's one of those typical, I think one of the earlier speakers mentioned, trade-offs. I think on balance, central banks will stick to their mandate, here too, by the way, and keeping inflation at the top of the agenda, trying to bring that down to their targets. And that might take another couple of years. So I think we're still looking for a fairly high interest rate environment for the next couple of years, accompanied by fairly low and slow economic growth on average. Obviously, that will differ from region to region.
And Professor, you've just detailed to us the various recessions we have found ourselves under as the world. What would you say, you speak of low growth, and what would you say when it comes to the instability the world is facing? What are the main contributing factors to seeing this low growth?
Yeah, well, let me kick off by saying that the kind of scenario I've just described is probably the best case scenario. There are actually still a number of risks to even this scenario. One of them being the point you're making right now, the potential of financial instability. I mean, it must make many people very nervous to sort of see a couple of big regional banks in America going belly up, Credit Suisse coming under pressure. We can't help thinking back to 2008, 2009, when we saw that huge financial crisis. So that has to be something that could present a risk and result in even lower economic growth. On the positive side, we do see that China having opened up again, that economic growth there is picking up, and that's always going to support the world economy in many ways. But the crisis, the Russian-Ukraine crisis, is still, of course, far from being resolved. The outcome of that remains uncertain. We don't really know what might happen over the next few months to things such as oil prices, things such as food prices. They've stabilized of late, but anything could happen, anything could change there. We have geopolitical tensions, of course. I've just mentioned one, Russia, Ukraine, and then also China, Taiwan. That kind of uncertainty is still alive and well. And then meanwhile, the entire global debt as a percentage of the global economy has reached yet another peak. It's around about 350%. That means if all the debt in this world, if we want to repay all the debt, it would take 3.5 years of the world economy to finance that. It's an exceptionally high number, and obviously sooner rather than later, debtors will have to try to bring down that debt. And whatever they do to do that is going to have a negative impact on economies. Just think about government debt. If governments try to lower their debt or destabilize their debt, it means, amongst other things, either spending less as a government or trying to raise more taxes, both of which are painful for consumers and businesses. So there's another risk, another sort of sustained risk we need to look out for. And the last one I want to mention briefly is a very interesting one, and that is the whole notion that the world might be deglobalizing. Now, I think maybe it's been a bit sensational the way people talk about this, but we certainly see that the global trade these days as a share of the world economy is lower, and quite a bit lower than, say, 10 years ago. Partly because of the slowdown in the world economy, but also perhaps partly because of some kind of ideological changes. So we see, for instance, the USA incurring more and more measures to protect their own industries. We see in Europe things like Brexit suggesting a move towards some kind of economic nationalism, becoming more inward-looking. So I'm not talking about, I don't think we're looking at the end of globalization, but certainly I think we're seeing a slowdown, a deceleration in globalization. So a number of political, economic, geopolitical issues that are troubling, to put it rather mildly.
Yeah. Professor, also coming, you've detailed what the world is currently faced with. In South Africa, we've had endless interest rates. We have a struggling economy, high unemployment rate. A number of South Africans are really worried. Where does this place South Africa with all these global challenges?
Yeah, I'm afraid you're quite right. Obviously, the situation here is partly the result of all these global trends over which we have limited control. Bearing in mind we have an open economy, it stands to reason that if our trading partners, such as the USA and Europe and China, if they are showing sluggish growth, that will filter down to our own economy. We think about the oil price. I see the petrol price going up again tomorrow by, 37 cents. Just as a slight footnote here, as recently as March 2020, the oil price was around about $10 a barrel. It's now roughly around about $80 a barrel, been even higher over the last year, but it's still 8 times more expensive a barrel of oil than it was a mere 3 years ago. That's not our fault, but we are obviously feeling the effect of that. We can say the same about many food prices. Ukraine and Russia between them account for 30% of the world's exports of grain, which in turn is a major ingredient of bread and noodles, which is for many millions of people their staple diet. So by the way, these rising costs of living and rising food prices, as is often sadly the case, are more painful for the poorer members of society. But then we cannot abdicate responsibility here in South Africa and say it's not our fault that the growth rate is so low, and it is exceptionally low. Many of the reasons are of our own making, and they range from high levels of indebtedness, lots of deficits, a government deficit, which is very big, household deficits, savings deficits. At a different level, we can talk about a job deficit. We can talk about a skills deficit. We can talk about an institutional deficit. So we built up these deficits over a period of 10 or more years, and now the chickens are coming home to roost.
All right, then.
And then if that wasn't bad enough, obviously, Eskom load shedding. I mean, some suggestions are that load shedding at stage 6 shaves off up to 2 percentage points of our potential economic growth rate. So yes, we're not in a good place. And unfortunately, when we entered COVID-19, this country's economy was already in a small technical recession.
All right,
so
then. Thank you so much,
COVID-19.
Professor. Unfortunately, we have run out of time. That is indeed Professor Roux. He is an economist from the Stellenbosch University Business School.